Hello, my name is Troy Epperson, and this is my website, oneononetrading.com. I've been doing trading and educating for many, many years, and if you're that guy that are almost break even, you're break even, you can't quite get over the line into profitability, maybe you could use a couple of hours of coaching that will really help maybe focus you and get you on your path to success. If so, please check out my website, oneononetrading.com, and I hope you enjoy the morning brief.
Hey, good morning, everybody. Welcome to the morning brief. Today is Wednesday, March 15th, and the 8:30 numbers just came out, and you can see that the core PPI was at 0% versus 0.4%. Core retail sales were minus 0.1%. Empire State Manufacturing, which is New York State, was substantially less than expected. That means that manufacturing is grinding to a halt in the Empire States, down 24.6 versus a minus 7 points. So big miss there. PPI Producers Price Index was down 0.1%, which is good. That's actually a good thing. Retail sales were down 0.4%. Bad. So we got bad numbers, bad manufacturing. PPI, it's okay. But again, the market just goes crazy with being happy about good or bad news. And initially we spiked up, and now we're about where we started before this news. This is not, retail sales going down is not good news. And Empire State Manufacturing is not good news. Producers Price Index is It's we don't want it going up, and it is going down, but very, very slight. So, But the markets have been really crazy, interpreting things in weird ways. It is what it is. So, taking a look at what else we have the rest of the day, business inventories, housing market index, all yellow items. Crude oil inventory is a yellow item because it doesn't affect the currency or the major markets, but it certainly affects crude oil if you trade crude oil. And we also have the long-term purchases at 4 p.m. None of those things are going to be red items or going to affect the market. So after this 8:30 stuff is settled out, we should be good to go news-wise for the rest of the day. Looking at the chart, so we had to redo the chart, right? We had this trend line going up here. Now we've moved the trend line down, and I put in a horizontal line at that December 22nd low, because that would be a double bottom. So we have it coming up on a double bottom if we continue down. Where can we come down? Based on the size of these bars, we're going to be stretching. So we're going to be stretching to get to whatever day that was, Monday's low, but that would be on the docket today, possibly 38, 39-ish for a low today, because we've already got a large bar. Now you can go back and look and see where did we have other large bars and what size bars were they. But I'm just getting a basic guesstimate of the average daily range and saying, hey, this is probably as far as we're going to go. Top side, maybe get to the highs of yesterday, 39.72. So those are some of your big picture perspectives there, looking for big picture patterns as well. Looking at the inventory here, this is a cumulative delta. So yesterday we had an up day and we had up inventory, which is correlated, and that's what is supposed to happen. So we've had expanding inventory for multiple days in a row, actually. Now today, this looks like it is also correlated. We're down and inventory is down. So those are correlated. When they're correlated, it means the market's acting like it should, which I'm not sure I know what that even means. Looking at the intraday chart, there is the initial pop at 8:30. So they initially loved the bad news, boom, But then as they had time to process, they said, the manufacturing is really not good. The retail sales is really not good. This is bad. And they're continuing to hit it on the downside. So intraday support and resistance. What do we have? We got some correlation at 39.07, a little bit at 39.12. And you got a little bit up higher at 39.38. On the bottom side, obviously, we have the overnight low and a Troy level, 38.68-ish. Another area, 38.53. Now, remember that even though the numbers the market really likes, and you'll see this happen over and over again, is the 50s and the 80s. So the 38.50, 38.80, those are normal numbers the market really likes for support and resistance. Just a little FYI. Another level of support, 38.37, say 38.38, and if we get down, 38.21 would be those intraday numbers. The Stock Traders Almanac is 57.1%. So we have a positive bias today, 57.1. Now, I got a comment from one of my YouTube videos that the Stock Traders Almanac numbers are not very good. So I just want to give you a little heads up as to what those exactly are. So if you buy the Stock Traders Almanac, which every trader should own that, you can get it at Amazon or Google Books. And it is a long-term percentage, long-term, like 200 years of stock market data goes into that number. So it is what it is. It's just a historical average. Does that mean that every year and every day it's going to be anywhere close to the historical average? The answer is sometimes, sometimes not. But it helps us get a long-term guesstimate of a bias for the market. That is really all it is good for, as if you've been tracking that, that is the situation. Remember to subscribe and to like. And remember that one-on-one trading is your place to get mentoring and coaching for traders. Hope you guys have a great day. See you tomorrow.